man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com. Today I've got another Q&A video that I found questions on the internet. Also, some have been submitted and through my Facebook page and some of the other channels that I have. So if you have any questions, comments, or concerns, please put them in the comments. I'll get to those in further video or future videos, but love the opportunity to help you with any questions you have about the real estate world. I do lending in Utah and Nevada, but I've been doing home loans since 1999, and I've seen and done it all and would love the opportunity to help you purchase or refinance a home. So the first question I have here is, should I use a mortgage broker when applying for a home loan? So I wanted to break down a little bit of what the differences are. So a mortgage broker is typically a person or a company that does not loan the money for that loan. So what they do is they have wholesale channels. They have other lenders. I've seen as many as 50 different lenders that these brokers will have that they can put your loan with that particular company. Now, what their job is to do is to know which lender takes what loan to do some of the shopping for you. So you're not having to call all of these lenders or get a bunch of denials or a bunch of lenders that won't do your loan. So a broker and an experienced loan officer is going to take your file, do the pre-approval, kind of review everything with you, and know which lenders will take your loan and which lenders will offer you the best interest rate. Very rarely do you have one lender that will do the loan. Usually there's a handful, 10 of them that will do it. And sometimes rates are better or guidelines are easier, or maybe there's just one or two things that make it more difficult to kind of narrow down which lender will actually do your loan. Now, if it's a cookie cutter FHA, Fannie, Freddie Mac, you're going to have a lot more lenders that will just do that loan. So they're really shopping the interest rate. But when you have issues with credit or down payment or income type, I would say that's probably the most common issue that you'll run into where you need more lenders is depending on how you earn your income, especially for people that are self-employed. So really a mortgage broker doesn't loan the money, where a mortgage banker or a correspondent lender, they'll loan that money. Sometimes they'll pull 10, 50, 100 loans together and then sell those loans on the secondary market and sell them to a servicer or something like that. So mortgage broker usually doesn't loan the money in their name. A correspondent or a normal lender does, and then what happens to that loan can be different with every different mortgage company. So there's benefits and disadvantages with both. There's different types of compensation with mortgage brokers. There's different types of lenders that they can use. Sometimes they're at the mercy of their underwriting with the other company, where most correspondent lenders underwrite in-house, so they have a little more control of what they're going to take risk on or what type of loans that they're going to do. So there's benefits and disadvantages both ways. I've been both throughout most of my career. In fact, the company I work for now does most loans in their name, but also has broker channels that if there's just something that doesn't quite fit what they want to do, we can access all of those loans. So very rarely do I have to turn clients away, but most of the time we can work on that client situation to get them better loans. And that's usually what happens when clients decide not to do a loan. Maybe they just wait to work on their credit. Maybe they got to work on filing a tax return or wait till they get done with a tax year to be able to do something. But that's really the biggest differences between a mortgage broker and a mortgage lender is just where the funds come from to fund the loan and who underwrites the file. All right, let's go through a couple other questions here. What is a HELOC? So this has gotten a lot more popular as people have taken advantage of incredible interest rates on their first mortgage. They're not looking at refinancing their first, but they've got a lot more equity. So they want to tap into that and do a loan or pay off other debts or maybe buy another property, something like that. So a HELOC, home equity line of credit, or HELOC, is a second mortgage typically that allows you to draw money against the equity of your home at a better interest rate than, say, a Visa or other types of debt. So it's really just a loan that's secured against the home, but you can use it, pay it back, like a revolving line of credit, like a Visa or anything else. So a home equity line of credit allows you to tap into some of that equity to do whatever you want with it. Go on a vacation, go home improvements, investments, buy another house. Home improvements, I would say, is a big one. That's why a lot of people will use the equity in their home to do their home improvements. So that is a great way to do it. Most home equity lines of credit are adjustable rate mortgages, so be aware of that they'll adjust based on prime. We have a home equity line of credit that is a fixed rate line of credit where you get all the money that you draw out. So let's say you get approved for a $50,000 line of credit, you get the full amount, then you pay that amount down. then you can draw back against the amount as you pay it down. So let's say 2 or 3 years down the road, you want to do some more improvements or pay off other debts, or expenditure comes up, you can then draw back that amount. Where like on a first mortgage, once you pay down that loan, you can't draw the money back out. It's just paid off. So that's why people will look at these lines of credit. And even with adjustable rates, they're way cheaper than credit cards. So that's why a lot of people have been looking at lines of credit. Okay, the next question I have here is, why do banks charge processing fees for home loans? So this is really an interesting topic of what is the front end of a mortgage loan and what's the long-term servicing, which is the interest rate. So most of the mortgage companies have to hire or pay for people's staff to do the origination part of a loan. So a processor usually works with the loan officer to package the loan together before it goes to an underwriter. And this is really crucial. The last thing you want to do is put the wrong documents in, or have something that's an error, or just not have the file put together before an underwriter sees it. You don't want an underwriter to have to just figure out the file. They want to have it stacked in a way to where they can review it, make sure it checks guidelines, and then that's when they either typically conditionally approve the loan, either suspend the loan if there's something major missing or major wrong, or deny the loan. Very rarely do they deny it right off the bat. I never see that. Most of the time, they're either going to suspend the file and say, okay, the income isn't what you calculated, or there's something wrong with the credit popped up, or it doesn't follow guidelines or something. And they give us some options to say, okay, go fix this, then we'll reevaluate the loan. Suspense is not good. When you get a suspense, that usually means that they're not going to work on the rest of the file until that issue gets cleared. So usually what you want is what's called conditional approval. That says, okay, once you meet these final little cross the T and dot the I's, we will approve your loan to go into the closing department to issue the loan documents to sign. So the processor is on the front end of that job to get the appraisal order, the title report, the homeowner's insurance. This is where the loan officer works with the client to get income documentation, proof of down payment, proof of earnest money, get the contract. All that stuff kind of gets gathered together with the processor to kind of make sure everything looks good before it goes to an underwriter. Because usually we'll catch most of the things that are wrong. Usually the underwriter will just have a few things that we have to clear up. And sometimes we will submit a file knowing that we're still getting maybe a pay stub or an update on something, just to get kind of a full final list for the client. But generally, I try to make it to where it's cleaner going in, so it's a lot cleaner on the way out as well. So all that work on the front end is where fees are charged. Because once the loan closes, it's not like the processor or the loan officer is making money on the interest rate. That's what the bank collects over the long term of servicing that loan. So the front end is where all the origination charges go, the title fees go, appraisal fee, all the stuff that's on the front end of the loan. They don't make anything on the interest rate going forward. Plus, those loans can be sold or reserviced or go other places. That's where investors are making money on the rate that's tied to the loan. So loan officers don't make any money on the interest rate. They make money on service on the original fees that are collected when the loan's first created, and any processing or support staff is what helps to make that process go. All right, let's see what we got here. Let me open up the screen here. It gives me a bunch more questions. Let's go into mortgages. Let's see. What are the benefits of FHA and VA loans for first-time home buyers? So you don't have to use a VA or FHA loan if you're a first-time home buyer, but typically first-time home buyers don't have as much down payment. Maybe they've got job history that's a couple different jobs. You're going to school, so there's gaps. So there's just certain things that make it to where other lenders won't do the loan, where FHA will. Now, it's more common for first-time home buyers to run into these issues. That's why FHA is really popular. To take a step back here, it also asks about VA loans. VA loans are only for veterans. So if you haven't served in the armed forces, you can't get a veteran loan. But if you have, it's one of the best loans on the planet, period. Whether you're a first-time home buyer, second-time buyer, you just have to be a primary residence, and you can only have one out at a time unless there's a divorce situation. There's that exception that if you married and bought a VA loan and then you get divorced and you want to buy another home, you can then have a second one out. That's the only exception with a VA loan. But either way, they have to be primary residences and you have to be a veteran. But if you've done your VA, I've had a lot of VA clients that will say, well, I already used my eligibility, I can't do another loan. That's not true. You can do another VA loan as long as the original one is not outstanding. So it's a great loan. Use it as many times as you can. One of the best mortgage loans on the planet is a VA loan. But one of the benefits of FHA is just the guidelines are a little bit looser in some of the categories that most commonly come up with first-time home buyers. But I've had first-time home buyers that have 20% down, have a 900 credit score, and don't need an FHA loan. So really, that's part of my job, is to take that client situation and say, okay, which program best fits their needs, whether it is a first-time home buyer program or something else. Don't assume that just because you qualify for a first-time home buyer program, that is the best loan for you if you're overqualified. So typically, first-time home buyer programs are people that are just on the edge of qualifying, and this just gives them a little leg up to help them get into a home, especially with FHA loans. There's also loans called Home Ready and Home Possible that are also kind of, I wouldn't say competitors, but just another way to get it done for people that kind of fall into FHA or first-time home buyer programs. So you can check out those programs as well. Let's see. Can you take out a mortgage from someone else if you're buying the home with your own money? Can you take out a mortgage from someone else if you're buying the house with your own money? Yes, you can. Somebody's always going to be willing to loan. So there's a couple different scenarios I want to clarify here. So if you pay cash for the home and then you want to refinance to pull the cash back out, yes, there's some seasoning on whether they go off the acquisition cost or the appraised value. So I wonder if that's kind of what this question is going for. So can you take out a mortgage from someone else if you're buying a home with your own money? Yeah, I mean, yeah, you can. I mean, yeah, that's the answer to that one. You can. So I just wonder why. So if you paid cash for it, are you trying to pull the cash back out? Or if you're just using your own money for down payment and you need a loan for the difference? Yes, that's just a normal loan. But can you take out a mortgage from somebody else if you're buying? Yes. Now, you can't do it at the same time, take out a mortgage and put the money down. You wouldn't need to. So I'm trying to figure out where this question would be. So maybe I'll respond to this person, get a little clarification. Okay. Let's see. Is it possible to get out of a mortgage and refinance at the same time? So again, this is a question that comes up a lot. So a refinance is taking a new mortgage to replace the old mortgage. So it's something where you get a payoff on your current loan. So let's say it's 250 grand, then you do a new loan at 260 grand. Part of the proceeds of that loan pay off the first mortgage. So you wouldn't need to get out of the first mortgage to then refinance to pay it off. So it happens at the same time, basically. So you'll keep your original mortgage, you get the refinance done, they'll wire the money to pay off the loan, and the new loan takes its place. Hopefully it's better rates and terms. Maybe you're pulling out cash. I mean, there's lots of different reasons to do a refinance. Most commonly is to lower your payment or pull money out. So that's how a refinance works, is it takes a new loan to replace the old loan. So you don't have to pay off your original loan to refinance. The refinance does that for you. It pays off whatever you owe on the current home. Now, I have times where they're getting money back. I've had other times where they have to bring money to the table. Most commonly, though, refinances don't require any money out of pocket. It's all just part of the new loan. It's all financed as part of the new loan. And usually you're getting some money back after it's all said and done. If you get more than $2,000 back, it's considered a cash out refi where rates and terms are worse. But if you're just paying off the lien that was acquiring the home, so the first mortgage that was buying it, and you're just rate and term, you're just getting a lower payment, then the rates are better. But whenever you get cash in pocket or paying off debts, even if it's a second mortgage, it's considered typically a cash out refi. Let's see. What are some of the pros and cons for refinancing a home with an existing mortgage? We kind of talked about that. The benefits are hopefully a better interest rate or cash back or reduced term. Or home improvements, money for home improvements, paying off other debts. The disadvantage is you may have a higher rate today. You're extending your term out typically. Now you can do a refinance where it's the same term or even reduce the term, but a lot of refinances go back to a 30-year fixed. But that also lowers the payment. So do something with the payment savings, and that will make up for any time that you lose on the property. But most refinances that I've seen go back to a 30-year fixed to just get the payment as low as possible, to free up as much money as possible, that type of thing. How do you choose between an ARM or ARM and a fixed mortgage when purchasing a property? So ARM or adjustable rate mortgage versus a fixed rate mortgage. There's benefits and disadvantages both ways. Most ARMs or adjustable rate mortgages have a fixed or locked in period, typically 3, 5, 7, or 10 years. Then it can adjust after that. So if you're not planning on keeping the home for longer than the adjustable period, that's where an ARM can make more sense. Or if your income's going to change or job's going to change or something's going to change to where you'll want to do a different loan. They're not bad loans. They got a bad rap. They're not bad loans if you know how they work. Most adjustable rate mortgages also have a cap on how much they can change and how often they can change after the initial fixed period. Most of the time, they're 6 months to a year after the adjustment. So let's say it's a 5-year ARM. That's probably the more common. They call them 5-1 ARMs. So it's fixed for 5 years, adjusts every year after that. The index and the margin is what determines the interest rate, along with the caps. So they'll add the index, which is all kinds of different indexes. That's what changes. The margin doesn't change. That's what you add, and that determines your interest rate. So, but they have caps. So let's say that your rate is 6%. Let's say the rate to start is 6%, and the indexes are, say, 4%, and the margin is 2. You'd add those two together. If it doesn't change your rate would actually stay the same. If it's way up, let's say the index goes to 10%, just way up, your rate doesn't go all the way up to the max index. It usually has caps on how much it can adjust. I know it sounds a little confusing, but it really is all in black and white. Your loan officer can explain it, ask those questions. What is the index? What is the margin? And how often can it change? That's when you can determine whether or not an ARM makes most sense. Now, it makes sense, again, if you're not planning on keeping the home for the entire 30 years or 10 years or 5 years. That's where ARMs can give you a benefit of a lower rate while you're in the property, where a fixed rate is locked in the entire time for the whole life of the loan. But I see people that will do that and then sell or do something in 2 years where that ARM would have maybe made more sense. So it's a little more risky, obviously, an ARM than a fixed rate loan, but it really just comes down to how long you plan on keeping the home. How are we doing on time? All right, let's do a couple more here real quick. What are the pros and cons of interest-only mortgages for first-time homebuyers? So this is another way of just calculating the mortgage payment. Interest only just covers the interest due. There's nothing going to principal and interest. Now, typically, interest-only mortgages are not for the whole 30 years. They're only for the first 5 or 10 years of the loan. Then it will amortize for the remaining 20 years of the loan. So the benefit for first-time homebuyers, it just gets their payment a little bit lower because typically first-time homebuyers don't keep the home long-term. Maybe it's smaller and they'll grow out of it faster or turn it into an investment property. So usually the first home is not the last home. So they don't keep it 10 years plus, not even 5 years typically. So it gives them a chance to just have a lower payment while they're in the home and then sell the property after that. The downside, of course, is it usually runs out. You don't put anything towards principal. And it's something where that payment will most likely go up at some point to cover the actual loan. But most of the time, it's well beyond the time that they're going to keep it. Keep in mind also that most traditional FHA conventional loans don't offer interest-only loans. These have to be different types of loans, which are usually higher interest rates. So the reason you're doing an interest-only loan is some of the reason maybe you just don't qualify for the other types of loans, but you will in the future. So it's kind of a bridge or kind of I don't want to say a Band-Aid, but just kind of a bridge to the time where you can qualify for a traditional loan or going to sell the property and roll that equity into the next house. Let's do one more. I try to keep them about 20 minutes or so. So let's see what else we got here. Let's see. What happens to a home loan if the property is not provided by the builder? What happens to a home loan if the property is not provided by the builder? So on construction loans, the construction loan will buy the land as part of the first draw. If the builder is providing the property, the builders do it a lot of different ways. They'll either have properties that they already own, like the land, and then they just say, okay, you pick the model that you want, and it goes on which lot, lot number 1, 2, 3, whatever it is. So the home loan will usually do both. When you buy it from the builder, he already has a price that has the lot typically built in. If you're just contracting with the builder to build it, you typically have to then own the land that it sits on. So this is something where any loan that's against the property will have to deal with buying the land as part of the property. You won't have a separate loan for the land and a separate loan to build the property. Now, you might have the seller agree to subordinate or wait to get paid off, but once the construction's done, those two balances get rolled into a permanent or takeout loan, depending on which type of loan that you do. You have a 2-time close with construction where there's 2 phases. They do the construction loan and then a permanent loan comes in and replaces it. So there's 2 closes. A one-time close is where you close not only on the construction loan, but the permanent loan once the house is done. There's benefits and disadvantages on both those types of loans, but that might answer this question. You really can't buy the property and do the build separate. They really eventually will become part of the same thing. Construction loans have a lot more moving parts. You have a little bit more approval. You have yourself, the builder, and the project. So you kind of have 3 levels of approval when you do a construction loan. So, and they all can go a little different ways. But we hit 20 minutes. You guys want to do one more? Oh, the guy in the back, he raised his hand. All right, we'll do one more. Let's see. How long does it take for the Federal Housing Authority, or FHA, to approve a refinance loan after all documents have been submitted? Newsflash, FHA does not loan the money. So they're not the lender. FHA insures the loan to the lender that if you follow the guidelines and you have an FHA approved underwriter that approves that loan, then if something goes wrong with the loan, that's where FHA steps in with their mortgage insurance. So really, FHA is really just a mortgage insurance company that has different guidelines that lenders follow, like us, but we actually loan the money. So our underwriter will review it. Documents and things don't go to FHA to review. They go to the underwriter to review. Once the loan's done, then they can do a review, or FHA's underwriters can look at it, make sure there's nothing missing, or that insurance actually kicks in. But really, they don't loan the money. FHA does not loan the money. They just set the guidelines that lenders follow, that if the loan goes into default, that's where FHA steps in and essentially reimburses the lender for potential losses or interest that's due or the balance. I mean, it's an insurance, so it's not 100% of what's drawn against the property, but it is something where FHA actually doesn't loan the money. So time frame from when you submit a loan to get approval depends on the lender. I would say most lenders right now are running 24 to 72 hours. I mean, it's not like they're crazy busy like we were, but they are starting to cut some of the support staff. You're seeing lenders doing layoffs and getting rid of processors, and underwriters are starting to lay off some people. So I think turn times will slow a little bit, because if volume kind of ramps up again, then people will be a little bit understaffed and have to go through a hiring phase. But really, the mortgage industry is really trimming down. There's more and more people leaving the industry, or there's more and more support staff that are being let go or furloughed or reduced hours, stuff like that, just as it slowed down. I mean, over the last 2 years, not really counting last year, but 2 years before that, we did an incredible amount of volume in the mortgage industry. I mean, just stupid amount of volume, because rates were so low. Everybody was refinancing. Everybody was buying houses. Now that things have slowed, especially on the refinance world, that's where support staff starts to be let go, unfortunately. But FHA doesn't approve the loan. The lender approves the loan, making sure it follows FHA's guidelines, but FHA really doesn't do any of the front end stuff. They'll do stuff on the back end once the loan's set up to make sure it was really following the guidelines, that it really was an FHA qualified loan. But the FHA doesn't underwrite the loan. The lender underwrites the loan based on FHA guidelines. Hope you found that interesting. If there's any comments, questions, things I got right, things I got wrong, anything you want me to clarify further, any questions you have, please post it in the comments. We'll do that in future videos. But I really enjoy doing these. I really enjoy what I do for a living, and would love to help you buy a home in Utah or Nevada. That's where I'm licensed, in Utah and Nevada. Been doing loans since 1999. I've seen and done it all, and would love a chance to work with you. So check out my website. It's listed down below if you want to get pre-approved or see what you qualify for, and love the chance to work with you in the future. Have a wonderful day.